is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us.
Hey, Hall.
Hey, Case. Thanks for taking time to join.
Yeah, no, thanks for making yourself available. I know we've talked before.
Yeah, it's been a while. How are things going for you guys?
Good, man. It's actually been pretty solid. I feel this sense of dire need to finish the IP for so many reasons, and it's tedious to make sure I'm not just wasting my time, like hitting a filing date I'm just gonna have to refile later.
Okay. It can be done, yeah.
So it's not like it's either not capturing enough of the differentiators, in a way that's nice and obvious, or it's some fundamental like procedural mistake because I'm doing it myself. But I've had a lot of feedback and I have a lot of assistance with doing the CAD design, so I'm now just trying to make sure that it's all a nice package. I have investors telling me that once it's done, come back and we're definitely interested. So
all right, so cool. Well, wanted to offer fundraise strategy to people and didn't know if you were what challenges you had with your fundraise, but we got a couple of ideas we always share with people and glad to share them with you as well.
Yeah.
What's the current status of your fundraise?
Yeah. So that's kind of the bottleneck right now is the IP. And so I have investors that are willing to follow. I'm looking for a lead right now. I don't want to say I'm looking for a lead, but I'm evaluating who is a good fit. And I haven't been reaching out with my pitch deck yet. So I would say my pitch deck is something I've been continually evaluating before I send it. I think if I presented it, then the story kind of tells itself. I should say I'm able to tell a story. If I'm not there to kind of, add to it, the story, then I just worry that it's a missed opportunity at bat, if that makes sense. Right.
Okay. And how much you trying to raise at this point, or raise overall, I guess?
Yeah. I've had a range on my deck, but I've been told repeatedly, you need to just put a number. So I put it down to 2. I would need 1 to get the prototype built. I think like $500K to get the physical prototype with the biology on it. I've got a deck I can show you real quick if you want to see the figures and stuff, but 2 million, I think would give me enough runway to hit the milestone if things got a bit rocky.
What's the one after that?
And then 5.
Then 5. Okay. So what we would say is let's go out and tell the market we're raising $7 million and we're going to raise the first 750 on a low valuation. What valuation are you thinking about for the 2?
The value cap I've been putting is 30 million.
Okay. Well, there's plenty of room there. So what you want to do is come up and say, I'm raising 750, but it's on a valuation cap of 15. Really low. I mean, that's a screaming good deal. But I'm raising 7 million. The first you do it in 3 tranches, 750, 1.2, and then you do 5. And 1.2 is going to be at 25 million, and then the 5 is going to be at 30 million, something like that. And when people start seeing that, they see, oh, there's 750 at a $15 million valuation, and that's the cheap money. If I want to get in, that's the one to get in on. So usually that goes pretty fast, and it's pretty small too. You don't raise a lot on a small valuation, but that's how you get your fast money is you make it very cheap and then say when that 750 is gone, we're going to 1.25, and it's going to be, the valuation goes up by 5, sometimes more, maybe 10 million, maybe it goes to 25. And when that's gone, we're going to go up another 5, and we're going to go to $30 million for the rest of it. So it does a couple of things for you. 1, you're putting out the big number, so they know you're raising enough to get to where you want to go. They kind of have the bigger roadmap. 2, if you want to be in at the low cost because they're valuation sensitive, it's right there. It's on the screen. Go for it. If you are risk averse and not sure it's going to happen, well, you can wait, but you'll just pay more. But that's okay. Once you had the first round done, people now have confidence that you raised money, and this has got some traction. And so getting the second one done, 1.25 is not that much more, but it's a higher valuation. And then boom, you have two funded rounds. Well, now the third one is the last one to go to. And you could break it down into more rounds if we thought it was too much to do 5 in one go. What I found is if you break it down, you can run deadline campaigns. When we get It's 500 into the 750. We declare in 60 days we're closing, and we can make that stick because we only need 250 left, and there's usually more than that circling around the top of the funnel. And you're putting out not only the invested, but the interest and committed that's behind it. I often find the interest committed, all the people who looked at it but haven't invested and haven't passed usually is a multi-million dollar number. But we all know that not everybody's going to come in on that. But it does show that there's scarcity here and there's demand for it. Other people are in the deal, or people looking at it. This thing's moving. And when you go from 500 to 750, that can be a pretty quick click, which is what you want.
Mhm.
The second one is getting bigger, and the third one gets bigger as well. But the same concept as you put it out there, valuation's going up, and if you want in, you're going to have to move at some point to get in on it and go forward from there. But that's one strategy. Now we're doing all this on valuation caps, convertible notes, safes, whatever, until someone prices it. Once it prices, well, then it just moves at that rate going forward. So you can work with both in that case. Yeah, so that's one strategy. What are your thoughts there?
Yeah, no, that sounds exciting. I mean, that's kind of that's one thing I was hoping to get from this meeting was what's a good strategy, because deadlines are something that I've been, kind of advised that I should start, applying for this FOMO type of paradigm. And to get some early stage, some fast money, that would be really helpful to start getting things going rather than having to put all my eggs into, I think I got pushback from like New World Angels that the value cap was too high. So
It's
from a
very
first
high at
time
this
founder.
point. Yeah,
Yeah,
that's
yeah,
why you got to get some cheaper money in there for the ones that want cheaper, and angel groups are in that category.
gotcha.
Even 15 is kind of high there, unless we have something really game changing that's already validated, not going to be validated, but if it's validated, we can make it stick. But I can see getting up to 30, but by then we're doing things that says this is worth 30 million. So you may want to, and that's the other advantage of this. If we go in and say it's the first one's at 10 or 15, and then we find that, well, no, it's really going to be a stretch to get to 25 on the next one. Well, maybe the next one's 15 and 20, and maybe the next one's at 20 or 25, and so you're not at 30, and by then you will have figured out where the market is, or maybe the market gets a better thought of it, and it is
Mhm.
reasonable. And this market is tough, but in the next cycle, I think it might be reasonable. So you have some time before you have to really figure that out. And you're giving them one number. Today, this is what's on the table. This number, 750 at 10, 15 million. This is it right here. Focus on it. But there's a roadmap here. We know what we're going to do, which helps people get the sense of the bigger one, because they're always asking, are you raising enough to get to where you want to go? But because they just don't have visibility into what the follow-on plans are. But each step has to have is part of the FDA path, as there's a milestone that has to be accomplished. We have to follow these patents. We have to run this trial. We have to get this approval or show this safety, efficacy, or what have you. And so I like to have the three curves in the deck, which is the FDA path, the milestones on it, and then the fundraise for each milestone. And so now it's got this logical thing where we kind of know. What I found investors really want is they want to know, and what we ask for is you have a defined FDA path. Even if you haven't had the final meeting with the FDA, you kind of know what they're going to make you do and what you have to do. And from here to approval, we know how much we have to raise. We know exactly what we need to do. There's no mystery about it. It's all right there.
Mhm.
FDA can come back and throw a wrench in that, but that's pretty rare.
Okay, that's interesting. Yeah, because I know that I have answers for the regulatory aspect of things, but it's not necessarily a hard answer. What I would think is a hard answer, because it's kind of uncharted territory in some ways. Some of it is, some of it isn't. I'm being a bit doubly ambiguous right now, but because it's the answer is it's complicated. Investors probably don't want to hear that. But yeah, this is interesting. So would you put that as one of the first milestones, or I guess before the Series A, when you say that like the value cap is like 30 million? It sounds like that's a question you'll want to have answered before that big raise to say it's worth X amount.
The issue we get into
A
is
bio
comps.
tool.
We
It's
have to
not
look
really
at
a
other companies at these
yeah.
stages. So if the 30 million is at clinical two, I think you can make a case for it. If it's at pre-IND, I think you're going to have a hard time making the case for that. I think most comps can be lower than that. That's why I kind of want to spread it out and do smaller raises up front to get the IP done, get these other things done. And the way you get it done is you give them a screaming good deal for a very, very, this money, this 500 or 750 is going to go for IP and maybe a few other things. And then when that's done, boom, we go to the next step. And Now we can start to move up the curve because we're doing more tech development or what have you. From a bigger picture, it kind of needs to make sense what we're doing at each stage. And 30
Mm,
million on stage one sounds high. On stage three, it doesn't sound very high because we've
yeah.
done all these other things in front of
Okay.
it to work our way up. And you can telegraph what the vision of it's important to put what we think the valuation should be at that point, but there's no guarantee and you may have to adjust down. So going, 15, 25, 30. It may go more like 10, 17, 25, something like that is what the market may bear at that point.
Mhm.
And so you adjust each one of those, of course.
Okay. So if I was raising 750, that'd be 7.5% of a $10 million value cap. And then I just, okay.
But it's,
Step.
it's small amounts of money. That's the key. Up front, it's the early stage is about minimum viable product, minimum team, minimum fundraise because the valuation is low. As you do accomplish things, the valuation goes up, and now we can do bigger teams, we can raise bigger money, we can do bigger things. And so you kind of want to think along those lines. What's the most I can do? So I really don't need a full team to do the IP. It's just me, or maybe you and the patent attorney. But then as we get into the second phase, we need more team members to help build it. And the team is kind of tracking along the stage that we're in and what we need to have done. And that it kind of again maps back to the valuation. If I get a team of 15 rock stars, yeah, it's worth $30 million. Look at all these guys working on it. But we kind of have to work our way up to that. So you might want to think about how the team adjusts according to each phase as well. And investors they're appreciating the fact that we're being very capital efficient. We're doing what we need to do at each stage at the right price versus just give me $50 million. I'll do this all in one go. Problem I found with the big $30 million all the way across is everybody wants to be the last one in the race. And we just can't all be the last one in the race. Somebody's got to go first. But you have to give them a reason to go first for sure.
Do you try to attract your lead for future rounds with that first, that
My
price?
experience is the lead does not come in until the second round. The first
Okay.
round, we're just trying to figure out if somebody's going to come in. And be candid, this is a lot of work for a 750K round to do all the diligence on it. I find they come in on the second round after about 500K is already raised. So you raise the first round, successful. Now you're raising the second round. That's when leads start looking at, oh, they raised before. Let's see how they're doing. Oh, it seems like they're tracking. Okay, now I'm going to come in. They don't want to raise all the money, but they don't want to be the first one in either.
Gotcha.
If it's verbal note and the valuation's reasonable, they're not head over skis already, then they're okay with waiting to see if this shapes up to be a nice deal. And they're looking for investor traction. If you've got investor traction, they want to
Yeah.
jump on a moving train. They don't want to jump on a
Mhm.
dead train and then have to get out and start pushing it. That's a
Mhm.
lot of work. That's why they're kind of watching how these things develop. And so that's where I would expect leads to come in. It may surprise you. You're in the right spot and they really want to be a part of it. That can happen, but
Mhm.
not. I'd hate to do all that work for a 750K round. I do that work for $1 million round and maybe a $5 million round as well. Because as you go further along, there's more evidence there. There's more to diligence. That's the challenge with early stage valuation. Is
Mhm.
sometimes there's just not enough data there to really figure
Right.
out what is this thing really worth. And follow-on investors look at the math. How we calculate valuation. They look at that very closely. And if half of them are swags and forecasts and guesses,
Mhm.
it's kind of hard to make that stick. But if you start
Mhm.
to fill in some of those with comps and you got some experience and you got some validation going in there with the technology or what have you, then it starts to get a little bit easier to make the math work and explain how you got to it.
I really appreciate this conversation, Hall. This has been really great in terms of strategy. How does this work out for you guys? What's your ask to help facilitate this? Because I know that's probably.
So we run fundraise campaigns. It's an investor relations program. It's 3K a month for a 3-month commitment. January goes to 4K a month for a 3-month commitment. And at heart, we're going to put you in front of investors. Go out to our network with your deck, build a list of interested investors, have you pitch them at our online events, then go to our roadshow events. We're going to be in Austin in January, Dallas in February, Bay Area in March, New York in April, and DC in May, and then circle back around to do that again. And then we'll be in LA in there as well. So the idea, and then we'll do it again in the second half of the year. And then we use dinner events to close. That's the key thing. And then we also do a series of other events to move investors along, thought leader events, deep dive events, investor update events. So it's a very structured process through events. We found some people They like the structured approach we have, which is all event oriented. We're putting a lot of events together, and we can help with fundraise strategy like we're doing here. We help with the deck and the term sheets and all those good things as well. So if you get to a place where most people come to us when they're halfway through their raise and they've run out of investors. So if you get 400 into the 750 and you run out of investors, that's when you come and we can help you finish out that round. And then we've had people come in and, three, 4 times over a 5-year period because they get stuck at different points in the raise and we move it forward. And then they step out and then later they step back in when they're further along or feel like they need more help. That's how we work. We're not a broker. There's no back end fee. It's just that if we have dinner events, we have to cover the cost of food, but I'll send you a campaign proposal. You guys can look at that and tell me if it's interest. I think it's when's the right time
Yeah.
is the better question here. I don't think today is. I think if you're trying to raise 750 for your IP, you just go do that with your network. You can do that. But when you start raising 1.5 and then 5, that's when people start to really need a lot more help because that's just a lot of family and friend, runs out long before we get to the end of that one.
Yeah, yeah. Well, I know when we talked last time, you suggested getting a term sheet ready for investors. Is that for this early stage, like friends and family? Because that's what I'm running into right now. Is like I can't find a term sheet. I've been told like resoundingly that they're gonna give it to me. But it sounds like for like a safe note, that's kind of the thing that I would need to find one, and I haven't really been able to find.
Well, for angels, they just want to be in the deal. They're writing 25, 50K checks. 25, 50K check writers are not leading around for an equity raise. They're jumping on board a post money safe note or a convertible note. So you just want to be in a place where you can take money. So if you're talking to your neighbor and explaining what you're doing, he pulls out his checkbook, say, "Hey, I'm in for 25." You want to be able to, have him sign the check. You sign the note. That money goes into the business the next day and you can start moving down the path with an IP attorney to get the patent work going. And we go after individual angels first because they're the fastest to close on these. Later, VCs, family offices, they have a much longer process for doing diligence, and they do look for angels. Are there any angels in here? Anybody else put money in? And so it helps to have some of that money in the deal. So you just want to have it from that point of view. And you find someone that's going to lead the deal, but they have to be putting in at least 100, 150K to do a proper job on the diligence of it. Like I say, 25K check tries really aren't leading around. There's just not enough money there to do the work that needs to be done. And on the second and third tranche, it's going to be a lot easier to put valuations together and figure out the math on that and what terms make sense for the deal as well. But I'll send you a campaign proposal. You guys can look at that and let me know if you have any questions about it. But that's basically the fundraise strategy we recommend because now you're giving them the big picture, but you're also giving them the point in time. Here's the raise right now. Because we often get people coming in playing the multiple scenario game. Well, I could raise $1 million to do this, or I could raise $3 million to do that. And you never want to do that with an investor. There's one team, one product, one fundraise, one outcome right now. And the idea is you don't want to get into what you could do because it just confuses the investor. They just don't know.
Right.
They all know there's options out there, but they kind of want to know what are you proposing as an option, and you kind of have to be proposing something to them. May get countered later, but up front you're proposing something, and it's pretty specific.
Okay. Yeah. And in terms of finding a safe note, there's just some online I should just look for because that's kind of what I'm at right now.
The Y Combinator, most favored nation, standard safe note. It's a post money safe note. It's got an MFN clause on it. You do need to put a valuation cap in there. I go look at the YC notes and pick that up and take the one with most favored nation and valuation cap and fill that out. And that's a good standard on it. The National Venture Capital Association, nvca.org, I think they have a model safe note as well. Angel Capital Association came out with a model convertible note. Funny enough, the NVCA does not have a convertible model note because it's a debt instrument, not an equity, and that's not a VC thing. But if we want to do the angel thing, convertible notes are a valuable way to do it. You can get the Angel Capital Association version, and what it does is it puts a lot of the terms back in that they're familiar with, information rights and pay to play, all these other board seats, all these other things are back in play. I teach classes to angel groups, and I'm often they're often amazed when they discover that an attorney has not reviewed this convertible note. I said, well, no, they just downloaded it off the website and filled it out. And so if you want terms in it, for board rights and so forth, you really have to ask for that. But the ACA, I thought, did a good job in putting some of that back in there for guys, so they would appreciate that, I'm sure.
Okay. All right. That's great. I appreciate it. I think I did. What Combinator? I had a hard time finding maybe theirs. Maybe it was PwC. Okay. That sounds great. Well, hey, I really appreciate your time. Oh, this
You
has
bet.
been
Oh, if you can't
really,
find it, let me know. I'll send you a link. I just sent it to somebody else an hour ago, but just send me a note if you can't find it, and we'll go from there. And appreciate you taking time. Have a good one and happy holiday.
definitely you too. Okay.
Okay, bye. Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.